want to bring this down to the average investor. They've seen the turmoil. You are the Uber bull. You say buy now. Sell me on why I should buy shares this morning.
Well, what the market correlates to the direction of earnings. Direction of earnings is driven by economic activity, which remains positive. You look at any of the data points, even the ISM, while it was a little bit weaker, is still above 50. So even with the turmoil you're seeing overseas, you still have positive economic activity in the U.S. That is driven by the yield curve, the slope of the yield curve, which drives the availability of money. That's driven by Fed policy, and that's driven by core inflation. So basically, until you see a real spike of inflation,
right,
that makes the Fed tighten enough to invert the yield curve and shut down credit, the last thing you want to do, in my view, is buy a down or sell a down 10% market, even if it looks wrong in the next few weeks. Over the course of the next 3, 6, 12 months, I think it'll be great.
If, as John Templeton would say, shares are on sale, will we see increased dividend growth and also increased share buybacks?
Well, I think you'll most certainly see increased share buybacks when the market weakens like this. Companies that have raised a ton of credit. One of the issues that the market has is the huge supply of corporate credit that's been created, and that went into the coffers of the corporations. They're going to buy back the stocks as they weaken like this. But again, I think the whole thing that the average viewer or listener should kind of get is that if you look back at any correction over the course of U.S. history, and unless you were going into recession, even if it was only halfway through the correction, for an investor, not a trader, because I'm terrible at trading, but if you're an investor, you want to be buying that kind of weakness. It offers you liquidity, again, as long as you're not going into recession.
So, Tony, if you're sticking with your thesis that corporate earnings are going to drive, this market, and they're going to be driven by GDP growth, which is improving, albeit slowly, do you sell the house in order to pile into equities?
No, I wouldn't sell the house to pile in there. One of the problems, I think Chris kind of mentioned that earlier, is derivatives and leverage may not be the greatest thing at some point. So no, I wouldn't sell the house to. I would actually. I think real estate and the housing look pretty good because there's credit availability continues to improve.
Turn a phrase. I mean, I just meant you sort of
Yeah.
I mean, if you're going to listen to me, unfortunately, the media, financial media, is full of people like me that come on and say, "Oh, my indicators buy the next tick." I'm not saying buy. I would buy the next tick with the assumption that you have no idea what the next few weeks are going to look like, but 3, 6, and 12 months out, you're going to be very happy you did. It's whether you can withstand the volatility, which is going to stay high. Typically what happens when you have volatility to this level, we measure it as VIX over 40, you have your kind of crash, which we did. You have a very sharp few-day bounce. You retest the low, and then you do what we're doing today. You're grinding sideways.
Right.
Eventually you retest that low.
Now, Tony Dwyer, thank you so much. I hear it's harder to come down Mount Marcy than go up it. Be careful out there, Tony. The deer flies the size of B-52 bombers.